Greetings from wherever you're joining us. Welcome to this special conversation on Kenya's budget statement for FY 2024-25. Remember, this is the period that runs between July 1st, 2024 and June 30th, 2025. This conversation is brought to you by Cliff Decker-Hoffmeyer. Delighted to be part of this conversation. My name is Julians Amboko. I shall be steering this conversation. And with me is an eminent panel. Right on my right here, we have Lena, who is a partner here at CDH in charge of tax and exchange control.
Good morning, everyone.
Great, as well as Kanyi, holding the same portfolio as a partner at CDH. Alex, karibu.
Auntie.
And finally, on the extreme end, we have Ruth Kendagor from the Institute of Public Finance, where she is the head of research. Karibu sana, Ruth.
Asante sana. Good morning, everyone.
Welcome once again. To set the stage for our conversation later on, we shall have Ruth kick off with a presentation to give us the high-level macros which informed the numbers of FY 24-25. Ruth, over to you.
Thank you very much. Good morning once again. To start off our discussion today, I would like to go through the budget numbers as presented by the budget statement, in the budget statement read by the Cabinet Secretary just the other day. So we start with a highlight of what we have in the budget. What is the total budget that we're looking like? How much does the government intend to spend? The budget statement tells us that the 24-25 budget, we're looking at a 3.9 trillion budget. This will be financed from a blend of domestic revenue, grants, and deficit. Domestic revenue of 3.3 trillion. This is broken down into ordinary revenue, that is tax revenue, 2.9 trillion, appropriation in aid or money generated from government services, the fees that we pay, coming to 426 billion. We have grants accumulating to 51 billion. And the deficit of the budget, the deficit between the expenditure and the revenues that we have, is to be financed from domestic borrowing at 263 billion and external borrowing at 333 billion. That is the starting point of our budget. Now, looking at the sectors that are to be financed within the budget, or the areas to be financed within the budget, we have the executive taking quite a good chunk of the budget, 2.3 trillion, the judiciary, 24 billion, Parliament 44 billion, equitable share to country 400 billion, and if you include the additional allocations, together with equalization fund, we have 444 billion to the county governments. We have 1.8 trillion for debt service, equalization fund 10 billion as already mentioned, and a total budget that looks at close to 4.7 trillion if you combine all these expenses together. Looking at the sectors, which sectors are gaining in terms of allocation? Which sectors are losing? What does it mean? In the recent past, we have been talking a lot about protecting key priority areas, social protection amidst fiscal consolidation. In the budget, we see an increase in the allocation to the national security, a significant increase, the biggest gainer, 16% increase to 30 billion. We have the governance, justice, law and order sector gaining 7% of an additional 7% increase from last year's allocation to 28 billion. The public administration and international relations sector allocation at 74 billion, 5% increase. Education sector gaining close to 5% increase from last year, with the budget coming in at around 16 billion. Then we have the energy, infrastructure, and ICT showing a significant investment by the government towards infrastructure. But we also have sectors that are losing, or sectors whose budget have been cut between last year and this year. And these are sectors that touch a lot on, the day-to-day life of citizens, especially the social protection, agriculture and rural development, general economic, environment, and health. The health sector takes the highest budget cut at close to 14 billion. And the key question we ask ourselves then is, how do we anticipate for the government to cover the expenses around the universal health coverage and the provision for primary health care? This is a big question that needs to be asked and looked into. In terms of the programs, going into the specific programs, just a highlight of some of them, whereas the sectors are actually losing or gaining at different paces, we are able to pick out specific programs that either have increases or have budget cuts, and we need to look at this and examine what these numbers tell us. So for instance, we have the fertilizer subsidy program with a 5.5 increase, with a 5.5%, 5.5 billion allocation, 122 increase. whereas the universal health coverage takes the highest budget cut at a decline of 14.2 billion, close to 77% budget cut. We have increases in other sectors, for instance, the livestock resource management, global fund still falling under health, the blue economy, and the climate investment, particularly for the FLOCA activities. For the health, we have the biggest budget cut in universal health coverage, already mentioned, and the free maternity health care. And so the biggest question we look and ask is, how do we expect to finance one of the key components in service delivery, one of the key issues that is at the heart of citizens, healthcare? Perhaps we anticipate to see the rollout of the shift beginning 1st of July. Perhaps the expectation is that with the implementation of the Social Health Insurance Fund and the contributions coming in, then we'll be able to raise money to supplement the health budget allocation. But again, the question is, looking at the allocation from shift, looking at the challenges that we're facing, the implementation of NHIF, what assurance do we have that shift is actually going to yield the desired results in both providing service delivery as well as cushioning citizens or providing citizens the resources needed to facilitate healthcare? And also, we also need to look at the benefits package that is given under the shift, to what extent are these sufficient to meet the needs of citizens. If we are to look again into the budget, from the perspective of revenue and expenditure, we have seen that we have a huge deficit this year. Actually, the deficit has come down as planned from last year to this year, from a budget of 3.9 trillion to be financed from revenue and grants, and we have a deficit of close to 600 billion. The intention or the anticipation, the plan is that this deficit will be financed from borrowing. But the question is, will the target numbers hold throughout the financial year? Looking at the past budget performance, take, for example, the financial year 23-24 that will be ending in the next 2 weeks. Starting from June last year, when the budget was approved, the planned deficit was 718 billion. The supplementary budget one, the deficit was increased with the realization of revenue targets to 886 billion. By the time we were getting supplementary budget 2, the deficit was 920 billion. The beginning of this financial year, we anticipate to cut down the deficit from 920 to 597 billion. The key question is, will this target be maintained? The key determining factor on the ability to sustain the target and really stick to these numbers as designed is the revenue and collection. If we are able to achieve the revenue targets, then we can confidently, with some level of confidence, say that the deficit numbers will hold, and we will therefore be able to uphold our fiscal consolidation path. However, if you look at past performance in terms of revenue, again, we see variations where the revenue targets have been revised consistently through the supplementary budgets, lowering expectations because the numbers are not coming in as was desired at the beginning of the financial year. If you look, for instance, at the targets for the financial year 22-23 and the actual outturn, we had a target of 2.1 trillion and an actual revenue outturn of 2 trillion. In the financial year 23-24, supplementary budget 1 gave a revenue target of 2.5 trillion. Supplementary budget 2 revised the revenue target lower to 2.4 trillion. The actual outturn as of April 2024 was 1.8 trillion. The quick question that holds here, will we be able to meet the revenue target with the remaining 2 weeks to the end of the financial year? And if not, what does this trend tell us in terms of the revenue targets for the coming financial year? The 2.9 trillion might be too ambitious. Again, if we examine further the deficits and the extent to which, as a country, we are able to uphold the deficit numbers, the targeted numbers, and ensure that implementation is sustained throughout the year. The medium-term debt strategy that was published around February this year gave us an analysis in terms of performance of the actual strategy or the actual target for the debt deficit, the balance between domestic and external debt, and the actual numbers. And we find that from the year 2019-2020 all through to 2022-2023, we have actually been missing the targets in terms of the balance between domestic and external. Beginning 2019-2020, we missed the targets, for instance, a deviation of close to 10% for the domestic revenue, 2020, 2021, 9%, 2021, 2022, 12%, 23, 24, 3%. Based on the exchequer releases as of 31st of May, we have already missed our target because we targeted a 50-50 ratio at the beginning of the financial year. But the numbers that we have as of exchequer releases in May is 57% for domestic revenue. Then the 24-25 budget presents a proper, a change in paradigm shift, an inclination towards higher external debt as opposed to domestic debt. We see that the budget targets are 56% inclination on external, and especially more on concessional debt, and 44% on domestic debt. And so the question is, to what extent will these numbers be sustained throughout the financial year? Then the other aspect towards revenue, and one aspect that is least spoken about and that we need to speak more about, is regard to appropriation in aid. As mentioned earlier, the government, the budget is to be financed from domestic resources, grants, and debt. Looking at the domestic resources, we have ordinary tax or ordinary revenue from tax, and we have appropriation in aid. In the last financial year, we have seen quite some changes in terms of the cost of services that citizens can access from government. Take, for example, the Ministry of Interior that reviewed the services and the costs that are going to be attached to these services. Look at the Ministry of Water, there were revision changes upwards for these services, the cost of these services. And so with the increase in the cost of these services, the anticipation would be that appropriation in aid, the target would also go up. But what we see is a decline in the target. And so the key question is, are we seeing a question of policy coherence? Because if you're increasing the cost of services, then we expect that the money that is going to be raised is going to go higher. But we see that there's a significant decline in terms of the target from 486 billion to 426 billion in the coming financial year. And it would be important or critical for us to evaluate and see, what does this mean to citizens with the decline target? Do we expect that charges will now go down? Then we ask the question of policy coherence, why raise it in one year or lower it on the other year? Or what is driving this decline in terms of target for the appropriation in aid? Moving forward, the other aspect covered in the budget summary are the tax reforms. We note that this year's budget statement did not cover extensively the tax reforms or the propositions in terms of taxation as compared to the other budget statements, perhaps because there's been quite some intensive discussions around the finance bill. But looking at what was covered both in the budget statement as well as in the finance bill, and bearing in mind that for the first time, Kenya published the medium-term revenue strategy that is supposed to be a document, a guiding document, giving a medium-term expectation in terms of outlook for the revenue strategy, the revenue plans that the government is implementing or is looking forward to implementing. And the purpose of the medium-term revenue strategy is really to provide a guiding document, not just for government, but also for the taxpayers to have some level of understanding and predictability of the tax changes or the regime that will be implemented. And so a highlight of some of the issues that we pick from the medium-term revenue strategy. We see that in the finance bill and in the budget statement that was read, a couple of issues were already highlighted and covered and already brought out as proposals to be implemented in the 2024 finance bill. But there are also critical issues that were left out, and the question is, what informs dropping or missing out on these critical amendments as we anticipated from the finance bill? So we see, for instance, the introduction of withholding tax on payments for goods supplied to public entities that was covered in the finance bill. There's the adjustment of the VAT threshold from 5 million to 8 million covered in the finance bill. The rationalization of VAT exemptions and zero rating so that we have less commodities benefiting, or rather we are able to reduce the tax expenditures that the government is giving. There is the excise duty, the review of excise on alcoholic products, tobacco products, and the East African community commodities. We have seen that covered. We have the motor vehicle tax that is covered, albeit with an amendment, which is welcomed, especially with the removal of the cap. Then we have the amendment to the Data Protection Act that seeks to exempt the Revenue Administration Authority from the provisions of the Data Protection Act so that they can use the information, for example, to be able to support revenue administration. We have the introduction of the minimum tax and the full rollout of the eTIMs. Some of the key issues that are missing, very critical, is the reduction of VAT by 1%. The medium-term revenue strategy anticipates that over the period, VAT will reduce by 2%. In the financial year 24-25, we would have anticipated to see a 1% decline, and this was to be supported again by another 1% decline in the coming years. However, we do not see this mentioned neither in the finance bill, neither in the budget statement, and so we don't anticipate to have this coming up. The key question is, why is it in the medium-term revenue strategy set out for implementation this financial year, but it has not been captured? Other components that we see, for instance, are the progressive phase-out of the preferential corporate tax rates as a way of addressing or streamlining tax expenditures, and the review of the digital service tax to include residents. The digital service tax has been reviewed, and there's propositions in the budget statement as well as in the finance bill, particularly with the change from the digital service tax to a significant economic presence tax. However, this still does not cover residents, and the thresholds given do not really, they're pretty high, they're not realistic for residents to be able to fit within those brackets for taxation purposes. Then as we look at the budgets, there are the other issues that are not mentioned within the budget that are of importance for us to speak about. And these are issues that policymakers, citizens, advocates, and actors all together need to look at and speak about them because they go hand in hand with the budget. One of the key issues is with regard to efficiency concerns in terms of budget implementation or budget actualization. Over the recent years, we have seen a big challenge in terms of budget absorption, where sectors, government entities, ministries, state departments are allocated budgets, but because of delayed exchequer releases, we have low absorption rates. Even instances where releases are made on time, we still see low absorption rates of the budgets. And so the question is, what are these administrative challenges that sectors and entities are facing that is limiting the absorption of the budgets? Another key critical question that needs to be spoken into is the performance of the non-financial indicators. Budgets are allocated against certain activities. These activities are measured and documented through the non-financial indicators. They are properly detailed in the sector working group reports. However, when you look at performance analysis in the sector working group reports, you find instances where a particular sector or a program, for instance, has absorbed the budget up to 98% absorption, meaning that the money allocated has really been utilized. But the performance of the non-financial indicators remain really low as 38%, 42%. And so the question is, if this money was allocated against a certain set of indicators, then the money is spent, but the indicators are not met. What justified spending those monies? What provisions or explanations are given as to why the monies did not address the specific indicators that were set? What does that mean for the next financial year? Because those indicators are meant to address service delivery to citizens. And so if they're not meant, then the gaps that the citizens needed in terms of service delivery are not addressed, and yet the resources have been spent. And so some of the implication would be that resources are again allocated in the following year for the same indicators that ought to have been addressed in the previous financial years. The other component that we need to speak to is with regard to our revenue and our revenue targets. And perhaps one of the reasons why we tend to get it not correct, let me not use wrong, but why we're not getting it correct with our revenue targets. A key question we need to ask as policymakers: what should be the ideal or the primary driver of revenue? Should we target revenue driven by growth, meaning that the economy is growing, the manufacturing sector is producing more, we have more value addition, we have businesses are booming, people are making more profits from business, therefore they're able to pay more profits. We have new industries coming up, the farmers are able to produce more, and so revenue is more growth oriented? Or should we have revenue being driven as a result of more taxes being implemented? Take a look at this analogy. The difference between the revenue target according to Supplementary Budget 2 for 23-24, and the revenue target for 24-25 is close to 465 billion thereabout. The budget statement tells us that the Finance Bill 2024 will yield revenue of close to 360 billion thereabout, meaning that the difference of around 118 billion is to be driven by growth. You know, the previous legislation as they were, the previous tax measures as they were, only that, you know, there's more growth in the economy and therefore people are able to pay more taxes. So we see that our revenue targets and our revenue numbers, our growth in revenue is more driven by additional taxes, more taxation or tax changes, as opposed to growth. When in an ideal situation, we would expect to see the other way around. Because if you have more revenue or revenue growth being driven, you know, increase in revenue being driven by growth, then you'd be able to see translating this into economic growth and better standards of living for the people in the economy. Then last but not least, we look at predictability of our fiscal reforms, both the tax laws as well as the budget revisions. We have seen the changes in the tax laws, for instance, as we have mentioned about the publication of the medium-term revenue strategy as a first for Kenya for a very long time. And we have seen some alignment between the finance bill and the medium-term revenue strategy. And for the first time, we can say there's an indication towards some level of predictability in the tax laws. However, there is still the question of the changes between the finance bills. Some of the propositions introduced in the 23 finance bill have now changed in the 24 finance bill, and this has implications, for example, on investors and business communities. But we still have a big gap when it comes to budget revisions, particularly with the revision of the budgets, with the supplementary budgets coming in that changes the numbers in terms of allocation, increasing expenditure, reducing revenue targets, and therefore increasing the deficit numbers, and leading to a question of budget budget credibility. And that comes to our highlight for the budget. Thank you very much, Julians.
Many thanks, Ruth Kendagor. They are giving us a very incisive intro into our discussion right now on the panel, focusing on the budget for FY 24-25, as well as contentious issues on the finance bill. And quickly getting into it, I should just give a layout that we shall be having this conversation until about noon, and then we open for some Q&A session. So prepare your questions as you listen into this conversation. Pivoting to my panel right away, Lena, listening to the high-level thoughts there, the numbers, the revenue targets quite ambitious, the deficit quite tight. What do you make of the budget for FY 24-25?
I think it's a stretch, considering the reduction in the deficit. I mean, to start that off, from an amount of about 900 billion to now we're looking at 500 and something, almost 600 million. The question I ask myself is how we intend to, you know, meet this deficit. Are we going to now focus on raising revenues from a tax revenue perspective, or what is the plan of the government in terms of enabling Kenyans to generate more income, pump more income or revenues into the economy, and therefore focus on growth?
Alex, we have seen the budget for the next financial year, and specifically the finance bill, lean increasingly towards indirect taxes for revenue mobilization, as opposed to the preceding finance bills where we saw direct taxes. What does this switch mean, and what should Kenyans expect?
I think what the government is trying to say is that we would rather target your consumption rather than target your direct taxes. So, and for consumption, you know, it's across the board. If you can afford, say, something that has VAT or excise duty, then you'll happily perhaps pay the tax, as opposed to targeting companies from a corporate tax perspective or individuals from a personal income tax perspective. So it's more a realization towards it's perhaps easier. It's a low-lying fruit to collect from indirect taxes than direct taxes. And this informs part of what we see with the government trying to do.
But Alex, just to stay with you on that question then, critics will argue that the problem with indirect taxes is that they're not equitable. And therefore the question of equity as a canon of taxation now comes into play. How do you assess that?
I think where we are at as a government, and for this government, it's not more or less about equity as we would want it to be. It appears to be more of how do we get the money? We have a stretched budget.
Yeah.
How do we get the money? Should we perhaps target the money that we can collect easily, and then we deal with the other factors later, such as, the tax being equitable or not? I think that's the struggle that the government is facing, and it informs the reason why we are seeing what we can see now.
Alex began by saying where we are as a government. I need to clarify, it doesn't hold brief from the state. And just for the avoidance of doubt, Ruth, let me give you some time to catch up with after your presentation and come back to Lena here. Lena, the Treasury CS spoke on Thursday last week, and one of the things which emerged, which we haven't seen in the finance bill, it looks like we're heading for a radical cleanup of the first and second schedules of the VAT Act, that is with regard to zero rating exemption. I wonder what your thinking is around this and what Kenyans should anticipate.
Definitely the prices of goods will go up. If something was subject to zero rated, means there was no VAT on it.
Yeah.
If now that will be taxed at the standard rate, we're looking at a 16% increase in terms of the cost of goods. So Kenyans should anticipate a hike in terms of the prices of goods.
I see.
Hence now higher cost of living, I guess.
I see.
Yes.
Alex, what did you make of that? Because we had seen this preempted in the medium-term revenue strategy, but we didn't expect it to be coming this soon.
Yeah, and I think the way they're explaining it is from an aspect of tax expenditure.
Yeah.
So one, you're struggling with VAT refunds, and because you have zero-rated goods, so you need to find a way to make sure that the list of those zero-rated goods are reduced. Secondly, you're also looking at whether the incentives that are provided within the first and second schedule are actually bearing fruit. The problem is they don't tell us. So, for example, you say you're going to perhaps exempt, someone who is perhaps building a tourism facility from VAT. The intention there is to ensure that then guys are actually putting up these tourism facilities. Then at the end of the year, what have we achieved with that particular exemption? So if we were to know what has been achieved, then we can perhaps join the government in saying we're in the right direction in terms of looking at the list in the first and the second schedule. We have, say, motor vehicle assembly, e-mobility, and things like those. Then you see certain changes being proposed within the bill, but you're not being told, when you introduce these incentives, what have you achieved and why are you now deciding to go back?
Yeah.
So if we had that data, then it could be useful so that then we can tell where the government is heading in terms of removing lots of stuff within the first and second schedule of the VAT Act.
I see. Ruth, let me come to you. So we now have three very important documents. We have the sessional paper number 2 of 23, which is the national tax policy. We have the medium-term revenue strategy. And here we have finance bill and the budget estimates, of course, guiding us into 24-25. When you look at those three documents, do you see coherence in terms of what you're talking about with regard to predictability of tax policy going forward?
Well, I would say that there's some level of coherence, considering that we did not have this in the first place. And this has been something that, actors, for instance, like our institution, has really been calling out for a very long time. As a first step, there's some level of coherence. A simple analysis, look at what we just presented, the elements that were given in the MTRS that are to be implemented in the financial year 24-25, and those that have actually found their way to the finance bill. But the key question that needs to support these documents, as my colleague Alex has mentioned, for me, I'm a very big advocate of evidence-informed decision-making. We need to have those documentations. If Treasury has those analyses, can this be made public so that it informs public discourse? Yeah. So that we're able to see that, by implementing, for instance, say, for example, the zero rating on exports. I mean, the tax is not the only component affecting exports. There are many other issues out there. It's a function of many variables. Can we look at all these other numbers and see which was the most optimal? Is the zero rating most optimal? Were there other alternatives that probably would have yielded better results? So there's some level of coherence, and the medium-term revenue strategy specifically points out, and if you look at the implementation matrix, talks about a number of studies that are to be undertaken.
Yeah.
Those really need to be undertaken and made public. specifically made public for reference.
And Julians, from a coherence perspective, I
Yeah.
picked the bit where Ruth was speaking about the ANA, saying it's dropping from 486 billion to around 420 something billion.
Yeah.
So 60 billion, where the government is actually increasing the fees for its services, but projecting to collect lower. I wonder why we don't have something similar with our taxes and audit where you then increase your taxes, but you're also realistic that as a result of increasing these taxes, perhaps our projections should also go down.
I see.
Yeah.
I see. Lena, let me switch gears with you a bit. One of the elephants in the room around Finance Bill 24 and the outlook for 24-25 has been this proposal to amend the Tax Procedures Act to give KRA free rein when it comes to access to personal data for tax compliance purposes. There's hue and cry out here about it. What are your thoughts, Lena?
Julian's giving KRA open access into personal information, I mean, brings about issues of the Constitution, you know, the right to privacy.
Yeah.
My view is, as it is, KRA has mechanisms and ways of finding out information that they would otherwise want to get information when they're raising assessments or trying to establish how much Lena or Alex or yourself earn. They do not necessarily have to have an open access into all the information as pertains individuals or taxpayers. So I feel it raises issues of constitution, infringes on the constitutional rights of Kenyans. And I think it's something that also needs to be moderated because as it is, it's not clear as to the modalities of how this exemption shall apply or how it shall be enforced. And to put it bluntly, I think they really need to revisit the proposed amendment.
But Lena, KRA as we stand already has access to swaths of data, and that is why they issue agency notices.
Yes.
So some have argued that this is simply trying to create a foolproof system whereby in case someone goes to court, you'll say, look, we already amended the Data Protection Act to give us this access.
Yeah.
So some have said, look, we are complaining about nothing. Already they have this access. How do you respond?
But they don't have access to everything.
Yeah.
You see, when an agency notice is issued, it's very clear, give us this information in respect to this person for this period of time. It is not all the information as pertains an individual. So they're able to get this information to raise the assessment. So why do they want more now?
Alex?
Yeah, so within the Tax Procedures Act and section, I don't know whether it's section 59 or 59A, you already have power for the commissioner to actually request information for purposes of collecting tax.
Yes.
So that's already within our laws. But what we have currently is then you have to use that within other existing laws like the right to privacy and our constitution and also the Data Protection Act as it is, because with the Revenue Authority, what you're looking at is, especially from a data protection perspective, is you don't want to encourage them to go en masse to the public and start collecting information for purposes of just collecting tax.
Yeah.
It needs to be guided and it needs to be also within the law. That's why we need the Data Protection Act. So the amendment then, what it will do is you have a police officer with a gun, but you cannot actually control what they do with that particular gun. And that's a dangerous situation. I see some of my friends within Parliament saying that will be dropped, but we'll wait to see if that will actually happen with the report that will be presented
this afternoon.
Yes.
By which I should say, actually, there's actually a press conference ongoing as we speak on matters regarding this, so we'll be keeping tabs on that. Before I come to Ruth, let me just stay with Lena for a bit here. Excise duty. One of the taxes which this country has really grappled with is excise duty because ideally it's meant to be a sin tax. When you slap it on bottled water and the likes, it ceases being. But when you look at Finance Bill 24, a lot of the adjustments done in Finance Act 23 are being reversed, whether it's mobile money transfer, whether it's betting, etc. Have we lost the philosophy behind excise? And Lena, what's the way forward with this?
Just to point out what Alex said, you know, I think we've gotten to a point as a country where it's not the tax principle behind a tax.
Yeah.
What we're looking at is where can I collect? And excise in and of itself is also a low-lying fruit. I mean, it's not the question of what sin, so to speak, are we trying to discourage?
Yeah.
Where can I collect tax and collect it easily? But while so doing, we've ended up affecting key sectors that also drive revenues in this country. For instance, the remission on excise raw materials that has been removed, and it goes to show that as a country, are we advocating for predictability, for certainty in terms of tax principles, or are we working backwards? Are we looking at what the budget is and what do we need to do to make that budget? And therefore, it goes, just to link it with what Ruth was pointing out in terms of the need for predictability in this country. In 2023, you cannot give me a remission, which you now come and remove in 2024.
Yeah.
And then what happens in 2025? Are you going to bring it back again? So are you encouraging investors into that sector? Do you want to kill industries? What is the plan? Where are we?
Alex, I sat down with the head of the accessible goods management system at KRA, and he told me, look, globally, the trend is that excise ceased being a sin tax. Excise is a revenue mobilization platform, just like VAT.
Then call it something else.
Alex.
Yeah, I think, and back to the studies that we are talking about. So you increase excise duty on certain goods and services. And I'll pick an example, say you remove that remission for raw materials, then that cost is perhaps passed on to the final consumer. The final consumer is not able to continue consuming the products of this particular industry or particular manufacturer. At the end of the day, remember, these same people, you're rewarding them for being top taxpayers from a corp tax perspective. So the consumption has reduced because of your excise duty. Fine, you collected your excise duty. Then on the income tax side, for this particular company, then you collect less. So it's not quite clear whether some mathematics is done behind this. And I know they're talking about the motor vehicle tax from a different perspective as well, because you have to look at the insurance company, they collect the tax on your behalf, and then they report further losses, which means you collect nothing from that side. I think that's the level of detail that we need the National Treasury with help from KRA to do. So that even as MPs and the president is looking at certain tax measures, at least that is informed by evidence and data and looking at the knock-on effects, so that we see, beyond just Finance Bill 2024, we need to see what exactly are we doing.
My plan is I want to throw a spanner into the works here. So right now, at statements, it has just been announced that the motor vehicle tax proposed by Finance Bill 24 has been dropped. What are your thoughts?
Well, interesting, because we already foresaw a problem with the implementation of that. I was anticipating this was going to be a similar scenario with the affordable housing, where there was going to be one court case after the other around its implementation. And so I think it's a good step to go back to the drawing board and relook at it. But then the key question is, looking at the target revenue that the finance bill was supposed to raise, there's an apportionment from the motor vehicle. There's a mention of around 58 billion, right?
Correct.
We dropped that. Where are we going to get that money from?
Yes.
Should we already say there's some tax somewhere that's going to go up? Should we already say changes on the deficit before we even start the financial year? What does that tell us?
Very good questions there. Alex,
Now that it seems the government, can we go back to this housing so that now we can demonstrate good faith?
prospectively.
That we can actually listening to what Kenyans are saying. But some of it we could kind of foresee it. Motor vehicle tax, I think I'm surprised that they've decided to go back. Things like VAT on bread, we knew that this thing will be removed because it's something they can use to get popularity in etc. So we're waiting to see all these changes that have been made. Perhaps maybe it's a step in a good direction. So we'll be happy about it.
Lena, are you happy now?
I am ecstatic. I am happy.
At least we want to move to third party.
Oh, yes. But then again, just to echo what Ruth has said, where are we going to get the 58 billion? Then I'm getting worried. What's the plan in terms of supplementing the 58 billion? Or is it now going to come back as a levy? Now that it's been removed as a tax,
Yes.
and there were issues of whether it's a tax for purposes of the income tax act, then is it going to be introduced as a levy? That's my worry.
I see. We wait for the details. The report should be tabled in the National Assembly this afternoon. As and when it happens, you can be sure you'll have the breakdown, at least on my handle, that is @AmbokoJH on Twitter. Let's come back to our conversation here. Folks, value-added tax on financial services, quite a sticky issue right now. And why I struggle with it, I remember when we introduced excise duty on financial services around Finance Act 2013 or something, the argument was, but they're not vatable anyway. So now here we are, we're talking about excise, we're talking about VAT. Alex, let me start with you.
Well, we had a discussion with guys from the banking industry, and they were saying that in many countries, you don't have VAT and excise on financial services. You have to choose one.
Yes.
And two, they're also mentioning that you're increasing the cost of particular financial services by around 39%. You know, this whole debate of financial inclusion goes to the window. And I guess even the profits that the banks are making will also be affected. But I look at it from a policy perspective, and even being in tandem with what's happening internationally. Who is this who's levying VAT on financial services? Why does Kenya want to be among the first countries that is doing so? And two, from an investor's perspective, because we're having a discussion with the East Africa Venture Capital Association, you will see, for example, the assignment of debt, they also want to put VAT to it. And you're in a market where guys are restructuring, trying to look for ways to survive. And then you put VAT on something that actually there's no value to it.
Yeah.
So from a policy perspective, I think we got it wrong in terms of those amendments. We'll wait to see whether some of those are then dropped, going by what the report from the committee will be saying.
I see. Before I go to Ruth, Lena.
I think, Julians, Kenyans have also become a country that we are more financially aware.
Yeah.
A lot of Kenyans have moved from what you call mattress banking to now, putting whatever small amounts, even in M-Shwaris and, all these financial products that Kenyans are now taking advantage of. And therefore, subjecting the same to VAT and excise would mean the prices would go up.
Yeah.
So I think the knock-off effect of that would be Kenyans will now pull back and go back to mattress banking. And we won't have as much money in circulation.
Yeah.
And we've already seen that, by the way.
Yeah. Yeah.
I think there's a time CBK was reporting that the money in circulation, the money that was being held by banks and the money vis-a-vis the money that is now in people's pockets, they see a trend for people now holding money back and not pushing it through banks and financial institutions. So you can imagine what then this does in terms of that money and people not then going back to the banks, as it were.
But guys, to flip this conversation and to be fair to the government, this is one finance bill which I read and I was like, there's really a deliberate effort to boost deductible allowances, whether it is affordable housing, whether it is a social health insurance fund. The pension sector had significant strides in this, moving to exempt. Don't you think some have argued that, look, it's a fair trade-off here. We're talking about onslaught by indirect taxes, but we are boosting the disposable income from which you should be getting that indirect tax. Ruth?
Well, the key question from that perspective is equity. The deductions, the deductible expenses that have been introduced, very much welcomed move.
Yeah.
But who benefits from those? Is it everyone in the economy? Compare that to what, for example, the excess tax on the financial services, who pays for that price? So whereas it's a good move and there's some level of balance, the key question is the equity angle that has already been mentioned, where we'll have now the deductible expenses, the salaried and the income people will be able to feel the benefit of such deductions, but with the continued implementation of the excess tax on financial services, this cuts across even those who are not part and parcel of the deductible expenses for pensions, for instance, those who are not covered on, any of these other applicable deductible expenses. So the question of equity then applies.
Because, Julians, the finance bill, and you've rightly put it, seems to work for employees. Yeah. So you've given me an extra 100 shillings.
But then,
in terms of exemption. But on this other hand, I'm spending 150 more because of the VAT and the excise tax implication on stuff that probably I consume. So where's the balance?
Yeah.
There's that, but also there's the aspect of a lot of companies will now feel stretched, probably shut down. So who are these employees you're giving exemptions to? People will be laid off.
Yes.
So it all has a snowball effect, and I think
Sounds
there
like
has to
just like
exactly. So there has to be a balance,
Alex.
I think it's good to point out some positive aspects within the bill, and especially those are towards employees, which is a good step.
Yeah.
And we appreciate the government for trying to do that. Yeah. But if I was to go back to Finance Bill 2023, where you said through the measures that were there, you're going to collect 300 billion. And then the way it is, you're actually closer to missing your target by that 300 billion. So why did we need Finance Act 2023 in the first place? Do we need a Finance Bill 2024? And will it actually achieve the 364 billion that they target to collect? So 346 billion, that they target to collect. So to me, it means that you actually didn't have to increase certain taxes. Why can't we ensure that whatever measures that are there are working properly, even as we introduce new other measures, so that we don't get to the same hole come end of 2024, 2025.
Yeah.
Because at that point, we will seriously ask, do we really need to be increasing taxes every year if the trend continues?
Okay. And staying with the sweet spots, Lena, advanced pricing agreements. I actually thought that was a very good proposal. The only submission that I made was we need guidance as to whether KRA is empowered to revoke an agreement entered into.
No, I think that was also a good proposal in the budget. I mean, it also gives a level of certainty, which has been an issue in terms of the tax regulations, and advanced pricing arrangements are a plus, but then the regulations need to be put in place to, just agree how it works. And number two, the question we ask ourselves is whether KRA does have the capacity to roll it out and to give timely APAs.
I see.
But
I think that was a good amendment or proposal.
For me, it needs to, first, it's a good proposal. Over and above what Lena said, tie it also on the custom side, so that then it is quite clear that once you agree, you don't agree with the commissioner domestic tax. And then once you're importing goods, the commissioner on the custom duty side is saying that was your own agreement. We don't recognize it. So we need to tie it to make sure that perhaps the regulations there's the 5-year period that is given. Perhaps it could address the revoking bit, hoping that KRA will stick to it. And it's something that is welcome.
Okay. I don't have any questions on the chat, so let me just remind you, in case you have any questions, shoot them on the chat. I will be able to read them and just throw them to my panelists. But meanwhile, Ruth, micro, small, and medium-sized businesses, the proposal to amend the Tax Procedures Act provided that failure to integrate with eTIMs, eTIMs is the electronic tax invoice management system, 2 million shillings per month penalty. I thought that was really steep.
Yes, it is. And what do we expect to see out of that? Allow me to refer to a different analogy. Some time back, I had a chance to interact with, communities and business communities back in the village, especially with the implementation of the AGPO, the Access to Government Procurement Opportunities. And, with the allocations set the 30% for women and youth and people with disabilities, what I saw in my village then, there was a lot of drive, trying to mobilize these special interest groups to actually register, get the paperwork, and get contracts. And they did get those contracts. For the first year, they did that. What they were not told is that once you're registered on KRA, you need to file your returns every year. So they got the contracts in the first year. They were not, educated well enough that they need to ensure they sustain the legal requirements, including filing returns. So the following year, none of them had a tax compliance. So none of them could get any additional business. And the little ventures that had started sprouting died off. That is what will happen to MSMEs. We introduced this reform. Fine, it may make sense. but we need to provide the support. I know that KRA has really tried to offer the education programs, the extra support. More needs to be done so that it is sustainable. You know, the target communities or the affected people really understand what this is about and how they are going to sustain its implementation so that it really is able to yield the revenue numbers, but also people know what this means and they're able to ensure they comply to avoid issues of businesses dying off as a result of the implementation.
Lena, I raised this issue with the chairperson of the Finance and Planning Committee, and he asked me, he told me only those who are non-compliant will be worried about the penalty. And how do you respond to that? I see you're really trying to be diplomatic.
The question I ask myself, Julians, is I think we've gotten to a point where, let me use this analogy. A child behaves a certain way because they fear being punished.
Yeah.
I hope we'll get to a situation where you'll get that child to behave a certain way because they appreciate why they need to act a particular way.
Yeah.
And just to bring it within the context of the eTIMs, you're forcing me to comply because I fear a steep penalty of 2 million. Probably that would even be my turnover for the whole year. Why not drive the conversation of helping people to appreciate that, you know, this thing makes compliance easier, makes compliance more effective. It should not be about the penalty. I mean, the way it looks like, one, you are enhancing compliance, but you also want to raise revenue, additional revenue through the penalty.
Yeah.
Give me motivation to actually want to comply.
Yeah.
Don't punish me or don't make me feel I will be punished and seriously punished for not complying.
Yeah.
It goes down to now the principle, you know, what is the reasoning, what is the spirit behind some of these amendments, you know? But as it is, I think for me, it's a welcome amendment because it makes it easier in terms of compliance. But what is the motivation behind it? That's the thing I just keep asking myself.
Alex, I read this proposal and I struggled with it because we have the Tax Procedures Act, which provides for penalties for failure to be tax compliant. Why do we need a separate provision for penalties for eTIMs?
No, I think what we're trying to do is just make it very punitive for anyone who then sidesteps the system.
Yeah.
But remember, we have these eTIMs that doesn't have a threshold. So you have businesses that will not do, say, your 5 million in a year or 8 million in a year, and you want to charge them penalties of 2 million per month. Is it per month?
Per month.
Yeah.
Per month.
Yes.
Yeah. So basically, you're saying if for 1 month this low-income earner is not able to comply with eTIMs, the next month they actually shut their business.
Yeah.
And I don't think they look at it that way. In Uganda, what they've done is put the threshold. I know we had some eTIMs regulations which had a threshold, which were disowned, and therefore we had another one which removed the threshold. But our neighbors, perhaps doing well already with the threshold, so that then you ensure this low-income earner is then not caught within eTIMs, number one. And two, you're also ensuring that they're also not caught within these penalties that we have.
I see.
Julians, where is a Mama Mboga going to get 2 million?
2 million
comply?
Yes.
No possible.
As it is, that Mama Mboga does not know how to get the eTIMs put in place. So why are you penalizing that person 2 million?
I see. And staying about the conversation about thresholds, the threshold for VAT is going up to 8 million, Bob, the first since 2007, and we moved from 3 million to 5 million. Many have asked me, exactly why is this proposal important? Alex, your thoughts on that?
I struggle with it because at the same time, while increasing the threshold for VAT, we're also saying for eTIMs, everybody has to be registered.
So what's the point of the threshold?
So what's the point of the threshold
disconnect
anyway?
again
So there's quite some disconnect there, which we need to have a conversation about.
Yeah.
So that it's clear where we want to go, especially for the low income earners. We know we want to net them within the bracket, which is fine and it should be supported. But how do we then support them to ensure compliance and sustainability for their businesses?
But come on, friends, let's be fair here. So on the one hand, we have given the small businesses a very supposedly easy to implement tax framework via turnover tax. But here we are telling you, since we are bumping up the VAT threshold from 5 to 8 million, unless you hit the 8 million threshold, you won't really be burdened with the VAT, the filing and compliance. So don't you think Lena, there's some progress made there?
I think there's a disconnect.
Yeah.
I think there's a disconnect, the two. And I do agree with Alex. We need to set a threshold and say, if you're below this point, then you don't really necessarily have to do any eTIMs.
Yeah, I see. Let's switch gears here as we move on. Digital marketplace. First of all, before we even get to the tax side of it, we have struggled, Ruth, with the whole taxation of the digital economy. If you read the MTRS, it is categorized as a hard to tax sector. When you look at the evolution, starting from Finance Act 29, where we came up with the regulations, now we came to DST, the Digital Services Tax. Now we are widening the definition of the digital marketplace. Are we making the right steps?
I think perhaps that could be one of the areas that the data protection, that the data protection amendment seeks to look at. Because looking at the digital space, there has been quite some evolution and some growth within the industry or the sector, if I may say so, within the last couple of years in Kenya. But the key question is, what are the standard practices globally? Yeah. And how are we benchmarking against these standard practices? Are we learning or picking lessons learned from other external countries, benchmarking to see what works and what doesn't work? So for instance, I was looking at the implementation of the DST across, and this is something that is also discussed, even in the global spaces. Some countries have, gone ahead to make DST applicable to both residents and non-residents. We have been neither here nor there whether we want residents involved or not. At one point, the medium-term revenue strategy says include residents, but now the significant economic presence tax does not say anything about residents. So the larger framework around the implementation and what exactly we want to target out of that is not yet clear, so that we can say then the policy is actually coherent in implementation. But the whole idea of taxing this particular market or this particular niche, we need money government needs money to render services. So I think it's okay for it to be taxed, just that the framework needs to be made clear. That way, then we can look at the policy and say whether it is coherent or not.
But Alex, speaking about the clarity of the framework, one thing I liked about the proposal in Finance Bill 24 is that it clearly signals that Kenya is moving away from a unilateral approach around digital services tax to the more conventional Pillar 1, Pillar 2 focused approach. Don't you think that's a step in the right direction?
It is a step in the right direction because we have to move with change in technology and the way things are working. So the traditional ways of collecting tax from your mama boga, that has to stop. And from your local companies, you have to then look at multinationals and the fact that it is true that they are actually deriving income from your own territory. And the question is, are they paying the appropriate tax on that? So it's a good conversation to have so that they also pay their fair share of tax. Perhaps it will lessen the burden on the traditional taxpayers that we have within the country.
Lena?
I also welcome the move, but I think what needs to be done is to set up the regulations or proper definitions of what amounts to significant economic presence. What does this mean?
Yeah.
But I do agree it's a step in the right direction. We have companies getting substantial amounts of revenue from Kenya, and they're not probably paying their fair share of taxes. So I really do agree this is a good development.
But one of the things which I found interesting about the proposal from DST to the significant economic presence tax is we're moving from an effective rate of 1.5% to 6%, which I found to be a bit problematic. I don't know what you guys made of it. We'll start wherever.
Yeah, and this is the bit where we have to look at our neighbors, be it Tanzania, for example, and the rates they're using, in other countries in Africa and the rates they're using. Because at the end of the day, we want to maintain Kenya as a competitive place of doing business. We have lots of multinationals who come to set up in Kenya and perhaps participate in that DST space, with the fact that Kenyans, take on technology very easily, e-commerce very easily. So they're looking at this place and saying, we actually going to get money out of the country. But the minute then you increase that particular percentage from 1.5 to 6%, which is times 4, they may also want to reconsider that particular focus on Kenya and move it elsewhere, which is something we want to be careful about.
I see.
Yeah.
Ruth, anything to chime in there?
Well, I think just back to the issue that we have mentioned a couple of times already here, is that what, the bigger picture beyond implementation, what is the outcome that we expect to see out of this, so that informs, again, policy issues, coherence or not.
I see. Lena?
I think Alex has really hammered it. How do we make Kenya more competitive as it is? We have a lot of foreign investment in that space. And not just foreign, also we have a lot of local companies that have gone into the digital space. So how do we encourage this sector that is now seems to be vibrant and growing?
I see.
Mm-hmm.
Friends, still on the press briefing happening right at State House, one of the emerging issues is that, and that's why I keep on looking at my phone, by the way, we now have a threshold for eTIMs based on the parliamentary group report at 1 million shillings in annual turnover.
Yeah.
Alex, what do you make of that?
You see, it ties to what we were talking about. You actually to have a threshold.
Have a happy day now.
But we suggested 5 million, not 1 million. So I hope when it goes to the House, they will push for that 5 million threshold as opposed to 1 million. We have started well, we can do better.
But come on. TOT starts from, turnover tax starts from 1 million.
Yeah.
That must be the thinking behind it. Alex. Yeah.
Again, it's progress.
It's progress. I think let's welcome it.
Yes.
Let's welcome it. Step in the right direction. And it also has a political angle. So then maybe the avocado farmers who are not making much, my grandmother who sells milk, they'll have reason to smile with this particular threshold.
Lena, anything to add there?
Nothing. It's good progress. It's good progress.
Celebrate the small
Again,
wins.
let's wait and see final report, but I think it's good progress. At least it's something.
Wonderful.
Yeah.
One of the things, and this question is largely to Alex and Lena, the definition of royalties when it comes to Finance Bill 24, I really shudder at how it is being expanded and what it means for taxpayers.
We are sort of moving away from international best practice on that. And again, the question I keep asking myself is, how are our tax policies advised? Because that would bring into the loop certain services that will probably have not been subjected to withholding taxes, and therefore are we going to with cross purposes with what the international best practice in terms of taxation of IP and all that seeks to achieve? Hence the pillar 1, pillar 2 kind of conversation again.
Okay. Alex?
I think having been in this space for some time, there are many things within the finance bill which you can clearly tell there was a case in court or the tax appeals tribunal which the revenue authority lost, and then in their view then they come and tell us we are amending the law to make sure that we then collect tax. Fine, they could be looking at it that way, but here you are, then you change the law just because you lost a case as an example, and then now you subject to tax things like license fees, withholding tax, which will not apply to anybody else, globally. So again, you position yourself as a jurisdiction that is a little bit unfriendly, and there needs to be a broader thinking around some of these changes that are done, especially after a case against the revenue authority. So I'm not sure whether the policy guys had time to actually look at it from that level of detail. It could be someone proposed and they were like, these proposals came from so and so, we'll adopt them. But what the effects were, I don't think there was some analysis done.
Okay. Friends, we are running out of time and have to begin dialing down our conversation. Let me start with Ruth. Given the presentation you made for us and the thoughts you have seen and what's coming from State House as we speak, what's your parting shot when it comes to budget looking into 24-25?
Two key messages or two key take-homes when it comes to the budget. So starting from the foundation that, I mean, government needs money, government needs to render services. And so one way or the other, the budget has to be there. We have to pay taxes, we have to raise money to meet the expenses. But two key issues need to come up. One is the Constitution has the good intention and spirit of participation, having citizens and all actors inform or participate in the public discourse around budgeting. And one of the issues that is very clear is that we are missing out the right time to talk about the budgets. We are talking about the budgets at the approval stage.
Yes.
We should have spoken about this at the budget formulation stage. We don't talk about budgets during implementation. We wait for the audit reports and then say, this wasn't right, this was wrong, this was good, this was bad. We need to be more intentional, both actors, citizens who have, the constitutional mandate and permission to talk about the budgets, but also National Treasury needs to open up participation, for instance, during budget formulation. That needs to be widened. Participation during budget implementation need to be widened. That way, if we participate more during formulation, we would speak less now at approval because we already know what's coming up. If we participate more during implementation, we would barely bother so much with the oversight stage because we already saw how it was implemented and we are either satisfied or we already go to raise our voices at that level. The second issue is with respect to effectiveness, efficiency and effectiveness. Back to the issue that I raised about, budgets being designed and resources implemented, allocated, but we still have low absorption rates. Even when we have high absorption rates, the non-financial indicators don't make sense. That really needs to be aligned. And that is something that comes in very strongly with the respective sectors, the MDAs, and this should be captured in the sector working group reports. So that even as we talk about the numbers and we talk about whether we are applauding the new taxes or raising a voice and say this is not equitable, and looking at what sectors are facing budget cuts or not, we are also saying that we are linking the numbers to service delivery and they go in tandem. That way we are able to have greater policy coherence within the space.
Just in case you're lost to what Ruth was talking about there are 4 stages in the budget process. That is the formulation, approval, implementation, and evaluation. So she has picked a couple of them just to tell us how we need to be participating as citizens in this country. Alex, your thoughts?
Yeah, this is where I give credit to Honorable Kuria and the Finance and National Planning Committee. I think for them, they go all out to ask for comments on finance bill, and they basically spend a lot of time hearing guys give comments on it. And if whatever we are getting on social media is anything to go by, it means that there's some listening also being done. On the budget side, and to disclose, we were hoping to also have Honorable Ndindi Nyoro here. There's a lot to be done in terms of improvement. For example, on the Honorable Kuria side, they'll even invite people even before people put in submissions, because they know who speaks about tax and they would want to hear about it. So the same proactive approach perhaps can be on the budget side to encourage more participation. Let's admit we don't do justice on the budget side, and it's a lesson we are learning, and perhaps we'll do better in the next cycle.
So what Alex is talking about, we have 2 sides to the budget side. We have the finance bill, which is revenue raising. We have the appropriations bill, which is now the expenditure side. What he's saying is that we are so much skewed towards the revenues raising side, which is the finance bill. We need to pay equal attention to the appropriations bill, which, by the way, is going through fast reading this afternoon in the National Assembly. So stay tuned for that. Lena, your closing thoughts.
I think, Julians, for once, I am glad that Kenyans have been very proactive.
Yeah.
In terms of the whole finance bill process and now the budget processes. I'm really happy that now Kenyans have become alive to the fact that these things are important and they do affect our lives in one way or the other. So kudos to Kenyans for rising, and already we're having certain many
on the go as we speak.
Oh yes. But also I think just to point out that whilst the government is coming up with some of these policies, either through the budget or through the finance bill, I think it's time that things need to come full circle. What is the reasoning behind it? How do we intend to achieve it? And what happens in between? And this goes now into the research, the data, what would be the impact of certain amendments, making informed decisions.
Yeah.
By the time we are having public participations as Kenyans, then we know you actually are justified in subjecting us to tax on this sector, because then this is the benefit we're having as Kenyans. So informing Kenyans, making informed decisions, and I think just being able to demonstrate that this thing go full circle and what would be the overall effect of some of these amendments. But kudos to Kenyans. I'm really happy that we're finally giving our own feedback and freedom. So.
Wonderful. Unfortunately, that's where we have to draw to a close this conversation we have been having on budget FY 24-25, as well as the finance bill, and getting real-time updates. I'm glad we had this at 11 a.m. because it's allowed us to take these things as they evolve from State House. So we shall keep this ongoing, and please continue sharing your feedback, and we shall be part of this process just to ensure that we are all on the same page. We are all engaging as citizens, because the budget process is for you and I. It's not for the legislators. That is why we get involved. Stay tuned to all the respective social media handles for any updates coming from this end. I've been your host, Julians Amboko. It's been a delight. Thank you so much for your time.